Let's talk about a concept in investing of intelligence over emotion. I remember listening to Peter Lynch, who was one of the greatest stock pickers of all time. He ran the Fidelity Magellan Fund in the 80s, part of the 90s, one of the most successful funds in mutual fund history. He was telling a story about when he went out to Omaha to visit Warren Buffett, that they were sitting in Warren Buffett's living room and he had the stock channel on. And as you know, there's a ticker tape that goes across the bottom of the screen. There's some analysis and dialogue and monologues and experts kind of weighing in real time. And Peter Lynch said it was odd because they were sitting in the living room watching it, and Warren Buffett had the TV on mute. And he just out of respect didn't say anything for a little while. And then eventually he just asked Warren Buffett, why is the thing on mute? And Warren Buffett said, well, I'm just interested in the data on the ticker tape. The rest of the stuff is just noise. And I can't emphasize how detrimental that noise is to the investment community or the investing community. I've been doing this for 28 years. The vast majority, I won't say it's 100%, but it's a vast majority of critical decisions, critical mistakes that people have made have come because of emotions. So it's not an issue of intelligence, it's an issue of being overcome by emotion or fear or greed. So getting into, and just be really clear from the stock standpoint. I mean, there's people that have the stomach to own stocks and understand there's fluctuations. There's people that just don't have the stomach for that. And there's nothing wrong with that at all. But you should not be in the stock market if you can't bear the thought of the value of your assets fluctuating from day to day. And I'd say if you cannot stomach a loss over a 3 to 5 year period, you shouldn't be in stocks. You know, there's other assets. There's risk-free assets. There's annuities. There's the bond market. There's a number of places to go to get your investment dollars working hard without the psychological side effects of being in equities. I will point out that the long-term investors uh, that are invested or have a position in equities, stocks, mutual funds, growth-based mutual funds will, historically speaking, have done very, very well in relation to those that don't have any position in equities. Some of us really don't have any choice. We need assets that grow in order to reach our goals. But again, I think this just comes down to the basic tenet that if you want to have a position in equities, you've got to be able to have the mental acuity to put that piece of your portfolio in a box, in a drawer, close the drawer, and forget about it. That's what yields a successful investor. Intelligence over emotion. The shortcut to being intelligent is just not following the news, not following or looking up your account every day. Those are counterproductive in a big way.